Japan is racing toward a bold new green energy future. But as the nation pledges to lift renewables to nearly 40% of its power mix by 2030, the critical question is, who will win and who will struggle along the way? Japan's energy policy calls for renewables to reach 36–38% by 2030, from just around 20% today. That means doubling capacity within 5 years. The push includes offshore wind, biomass and solar, backed by subsidies and feed-in tariffs. But challenges remain: aging grids, high import costs, and balancing nuclear restarts with green investment. In the landscape of Japan's energy transition, few companies offer as direct an investment as Renova. As the nation's leading pure-play renewable energy developer, Renova has positioned itself at the forefront of the green revolution. Its entire business model is dedicated to decarbonization, with a diverse and growing portfolio of projects spanning utility-scale solar, advanced biomass, and both onshore and offshore wind. This singular focus makes it a bellwether for the health and progress of Japan's renewable ambitions, attracting investors who want unadulterated exposure to this long-term structural shift. And recently, the company delivered a powerful demonstration of its operational leverage. In the first quarter, operating profits surged an astonishing six-fold year-over-year to 3.3 billion yen. This dramatic turnaround was primarily driven by the successful restart of several key biomass power plants following periods of scheduled and unscheduled maintenance. The performance wasn't just a recovery, it was a statement, showcasing the immense earnings potential that can be unlocked when these large-scale assets are running at full capacity. The result comfortably beat consensus forecasts, catching many analysts by surprise and triggering a significant rally in its stock price. For a market that had been cautiously watching Renova's execution, this powerful earnings beat provided a much-needed dose of confidence, reaffirming the company's ability to manage complex industrial assets and convert them into substantial profits. However, the path for Renova and its investors is far from smooth. The stock remains notoriously volatile, a reflection of its business model. Developing renewable energy projects is incredibly capital-intensive, requiring massive upfront investment long before revenue is generated. This creates a lumpy earnings profile where profits swing dramatically based on the timing of a single project's completion. A delay can shift billions of yen in expected profits from one fiscal year to the next. For investors, this makes Renova a quintessential high-risk, high-reward proposition. The risk lies in execution and timing, but the reward is direct participation in one of the most significant industrial transformations in Japan's modern history. Now let's turn our attention to eREX, a company presenting a very different investment narrative in Japan's green energy space. Unlike established giants, eREX is a specialized player, carving out a significant niche in biomass power generation. Their journey began in electricity trading, but they've since pivoted to become one of Japan's leading independent power producers. This strategic shift makes their story compelling, but also exposes them to a unique set of challenges. Looking at their recent performance, the top-line figures show robust growth. Sales grew 11% year-on-year to 37 billion yen in Q1, driven by new power plants coming online. But the bottom line tells a more complicated tale. Despite strong sales, eREX slipped into a net loss. The primary culprits were soaring operational costs and punishing foreign exchange losses. With the yen weakening, the cost of importing dollar-denominated biomass fuels like palm kernel shells skyrocketed, eating directly into profit margins. This currency headwind is a critical risk factor. To mitigate these domestic pressures, eREX is aggressively pursuing an overseas expansion strategy, focusing on Southeast Asia. A flagship example is their work in Vietnam. In partnership with local players, eREX is developing new biomass power plants, aiming to replicate their Japanese success story. This isn't just about building power stations, it's about creating an entire supply chain. They are exploring local sourcing of biomass, which could insulate them from the currency risks plaguing their Japanese operations. The strategic rationale is clear: diversify revenue streams and create a more resilient, globally integrated business model. Alongside their core generation business, its trading and retail power businesses also expand steadily. For investors, eREX presents a classic case of a growth story under pressure. The potential is undeniable, but the risks are equally apparent. Profitability is highly sensitive to fuel prices and forex rates, and the success of their ambitious overseas projects is not guaranteed. Execution abroad will be key to unlocking a new phase of profitable growth, making this a compelling, high-stakes narrative to watch. At the heart of Japan's second-largest economic zone lies Kansai Electric Power, the energy backbone for over 20 million people in the bustling region of Osaka, Kyoto, and Kobe. For decades, it has powered the nation's industrial might, but now it stands at a pivotal crossroads, tasked with leading one of the world's most ambitious energy transitions. Recent financials reveal a complex picture. Q1 profit fell 20% to 134 billion yen, a headline figure driven by Japan's fuel cost adjustment system. As global energy prices fell, so did pass-through revenue. Analysts urge looking past this volatility, the underlying business is robust. Progress towards its full-year profit target is an impressive 34%, well ahead of its 5-year average, signaling strong demand and high operational efficiency. The company's forward-looking strategy is a masterclass in balance. Kansai is deploying over 1 trillion yen by 2040 to reshape its generation portfolio, targeting 9 gigawatts of new renewable capacity, with a focus on offshore wind and large-scale solar. This green expansion is carefully integrated with the strategic restart of its nuclear fleet. Plants like Takahama and Ojai are central to providing stable, zero-emission baseload power, a critical component for grid stability as intermittent renewables come online. This dual-pronged approach is designed to decarbonize reliably. For investors, Kansai Electric represents a unique, hybrid opportunity. It offers a de-risked entry into Japan's green transition, where the growth of its renewables pipeline is anchored by predictable cash flows from its utility business and nuclear assets. This ambitious capital plan is being executed while maintaining a firm commitment to shareholder returns and stable dividends. While regulatory risks persist, Kansai Electric stands as a stable core holding for investing in the long-term, pragmatic transformation of Japan's energy landscape. Japan is not alone. Europe leads with offshore wind. The US invests billions in green hydrogen. Japan lags, but is catching up fast with projects in Akita, Hokkaido, and Kyushu. Policy support is strong, but execution speed will decide whether Japan can compete globally. So what should investors watch? 3 things. First, project delivery. Do Renova and eREX bring plants online on time? Second, policy. Will Japan sustain subsidies and loosen grid constraints? Third, dividends. Kansai's payout shows stability, but can it last amid rising investment? Together, Renova, eREX, and Kansai Electric tell the story of Japan's renewable pivot, a compelling narrative of risk, ambitious growth, and the promise of long-term stability. Japan's green energy journey is just beginning. To see what happens next, follow Sakura stock for the next chapter.